Well, hello, amazing Financially Fierce community. I need to do a small little apology, and then I'm going to tell you about today's episode. You may, if you are a regular listener, have noticed that last week we didn't actually release an episode, which is entirely and totally my fault. So I just wanted to say a little sorry if you missed last week's episode. It's because there wasn't one, but I'm back in the studio. I have a 4-part series coming for you, at you, to you, that I'm really, I don't know if excited is the right word to use, but I am confident is going to help you from a financial standpoint. And it kind of wraps into the theme, if you will, for the series. So before you check out, I want you to know that even if this feels diabolically boring or something that you are totally and utterly disinterested in, I just would love to ask that you stay tuned and stay listening, because it's one of these things where we need to know about them. We need to get them probably and understand them, but the listening and the wanting and the desire is often very low. Yes, my friends, I am talking none other than insurance. I know, stick with me. I'm going to do a 4-part series because insurance is actually the thing that I specialized in, which I don't know if you knew that. I spent over a decade inside big, large wealth management companies, but actually what I specialized in was insurance. And I thought it seems crazy that I have this damn podcast and I haven't split out and gone deep into the different types of insurances, what the hell they are, what you need to know, when do you actually need them, when do you not need them, what do you need to know in terms of health events and costs and all of the implications. So why the hell not do a mini series on that? Which is exactly what we are doing today. And I guess why this wraps into my apology is, A, if you're new here, welcome. B, if you're not new, you'll know I have had my own flurry of health events over the last couple of years, and I have kind of talked a little bit about it, but over the last few weeks, months, I have clearly influenced my family to do so. I hope they don't really listen to my podcasts because they get enough rambling from me, so hopefully they won't mind me saying this, but my dad has been unwell and actually is off to the surgeon again today to have something done to his neck. He might need to have spinal surgery, which has been a lot. And my brother last week just decided, why not get in on the show, and had his appendix taken out. And you just never know when life is going to give you an opportunity to wish you had insurance in place and or claim if you already had insurance in place. So sorry, I didn't have an episode last week. There's just been a lot of stuff going on. I've had a really big project that I've been working on that was due. And then my family just decided to be unwell because what better timing? And so that really wraps quite nicely, I think, into a series on insurances. Today, I'm going to set the scene in terms of what the hell does this whole thing even mean, some of the really important differences that I want you to know about in terms of the stuff that you get kind of gift with purchase when you take out a super account versus getting it strategically. When you get it strategically and you apply for it, what are the outcomes that you could have? And then in today's episode, I want to go deeper on the one that is probably the most common and easiest to understand, which is life insurance. But I want to tell you and teach you a little bit more about what to think about, when you should have it, when you shouldn't, and just all the damn things when it comes to insurance. So strap yourself in, get a cup of tea, get excited if you can. Today, we're talking all things life insurance. This is a podcast for everyone that wants to learn how to make fierce and bold choices with their money. We'll talk about how to shape your money mindset, investing for your future, your spending habits, the good and the bad, plus how to achieve your financial goals, and most of all, how to be financially fierce. I'm a financial educator and I want to empower you to be more in control of your money and build the financial future that you want. I run the Greenhouse Money Growing Program, and you can find details of that in the podcast show notes. My name is Jess Brady. It's time to get financially fierce. Okay, so I want to start by saying that there is a wonderful friend of mine who I do believe listens to the podcast, and hello you, if you are listening, who only a few weeks ago messaged me to say, yeah, I need to have that surgery that I was hoping wouldn't need to have. And I was like, oh, good Lord, because I had said to him, let's say a few years ago, my dear, you need to get your insurances sorted. And he runs his own business and, just busy, because aren't we all just busy? And he was like, yeah. And of course, like many, had that on his to-do list, waiting ever so patiently, and then had a few health events. And that was the run up to getting this message saying, hey, I'm going to need this pretty hardcore surgery. And I said to him, for God's sake, tell me you got your insurance in place. And he's like, I did not, which is always a really, it's a hard thing to hear because you want to help people and you want everyone, you never want it to happen to anyone, but when it does, you want people to be insured to the bloody hilt. And so I said to him, okay, look at your super and tell me what you've got inside super. Like maybe you've got something that you can claim on inside super. And so he sent me like a little picture, and unfortunately he just has life insurance and total and permanent disability, which I'm going to cover in another episode. And he was like, I don't seem to have the one that covers my income. And weirdly, my life insurance isn't that big of an amount of money. I actually thought it was a lot higher. And I was like, yeah, it is really annoying that we don't necessarily pay attention to this seemingly trivial, boring stuff until something happens to us. And then we become, dare I say, quite interested in what we are covered for, at what levels we are covered for. And you never want that shock, especially if you've had a health event, because now it becomes so much harder to be able to get it. So my quest over the next couple of episodes is to arm you with enough information so that you can make a good quality decision on what you need, what you keep, what you get rid of, what you increase, decrease, etc. Because there is a lot to insurances and they can be seen as quite boring. There are so many people who are like, I just don't ever think I'm going to be able to claim on it. So like, what's the point? Or I can't afford it, which we're going to talk about throughout the series as well. But what I never want for you or any of our Financially Fierce community, which I've literally just checked the numbers before I came into this studio, there are so many of you who listen to these episodes. And so like a ginormous thank you, because I'm just here bobbling around into a microphone hoping for the best. And I actually sometimes forget that there are people on the other side that are listening, and there are many of you. And so I don't know if y'all are out there sharing, doing the, I was going to say Lord's work, but I don't know if that is, telling people about Financially Fierce, recommending it. If that is you or has been you or is going to be you, oh my God, I'm so grateful because the numbers are somewhat intimidating. So I'm just going to try to keep my cool and pretend I'm talking to no one. And let's get through this episode and hopefully I get into my insurance flow and give you some good quality nuggets of gold. And maybe also just that little push to do the thing, because knowing and doing, we know knowing and doing are so different, and knowing and doing with money is different again. And especially when it comes to insurances, because you can finally feel like you're getting on top of it and feel like you're hitting all these roadblocks and think, I can't be asked until something happens. And let's not have that happen to you. All right, let's not find out that we're not insured for the right thing, not at the right level, not with the right definitions, et cetera, when something shite has happened. Yeah, let's use the time, hopefully, that you have right now where you are hopefully fit and healthy and on top of the world, because like, isn't that how we are all feeling in these times? Let's use whatever version of that you're currently experiencing to sort out your risk strategy, because I love talking about how you make money. I want you to make money, but I want you to protect yourself simultaneously. And it would be so wrong of me to just pretend like life is happening to everyone else. Other people get sick, not us, not here, no thank you. And yet if my family is anything to go by, no, annoyingly, if it happens, it seems to all happen at once, just to like really test your resolve. And we all know someone who has had something terrible happen to them. And whether they were prepared or not financially is a different story. But I have seen more than enough cases where people's literal lives were done or undone based on what financial stopgaps they had in place. The first stopgap we look at is, do you have emergency savings? If the answer is yes, tick, we progress to the next stage. Then we look at, do you have any bad debt? Can we clear all of that? Tick, awesome. But we also want to make sure that if that emergency savings runs out, because God forbid it's a big emergency or a long-term situation, we have ourselves protected. If you protect your car, your cat, your, couch, but you don't protect yourself, we need to stop and pause and go, are they really more important than me? And maybe the cat is in your mind. But if you don't have your insurances set up, your prob's not keeping any of those long-term, which sounds awful, but the reality is you need money, and emergency savings only gets you so far. So let's figure out how we can financially save your ass and not have you feeling like diabolically undone if anything bad was to happen. So I sort of talked about this idea of gift with purchase. I want to talk to you first about the insurance that you may be given, not for free because you pay for it inside your super, but you haven't had to jump through any or potentially many hoops versus what we call retail insurance or retail life insurance, because they are seemingly quite similar on the surface. But my friends, when it comes to insurance, like the devil is in the detail. The devil is in the detail. If you can take nothing more away from perhaps this episode, is you don't want to find out what you thought you were insured for is absolutely in no way what you are actually insured for when the time comes. We want to get in the weeds only momentarily. The best time to get in the weeds is when you are setting everything up. So then you have complete comfort that when and if shit hits the fan, you don't need to get in the weeds then in a panicked situation to be like, oh my God, is this covered? You're like, yep, I already looked at that. I'm sweet. So when we look at super issued insurance, there's a couple of things. So we call this group insurance or default cover. They are normally not something that you need to go through any sort of medical assessment for, but there is a lot of restrictions as a general asterisk that you need to be aware of. First and foremost, normally you haven't picked how much cover you have or even potentially what types of cover you have. It normally gets picked for you either based on a combination of your age or your income or a variation of the two. And that may be wildly appropriate for you or not appropriate at all. So the types of cover that you have may not actually match your needs. The levels of cover that you have may be completely out of whack. And so whilst it might be nice to have something, we want to make sure that the something is actually the something that you're going to want if things were to go wrong. And I find it quite odd, if I'm honest, especially as we're talking about life insurance in today's episode, is that the most common one that people get when they sign up to a new super fund is life insurance and total and permanent disability. And so if you are a young person, you are probably likely to have some form of life insurance inside your super. Not always, so definitely go and check. But I would argue that when you are your youngest version of you is when you probably statistically have the lowest need for life insurance. You actually have the highest need for income protection, which we're going to talk about in the next episode, but there's just a mismatch in terms of what they give you, when they give it to you. And so that is the first thing. If you've got life insurance, awesome, maybe, but do you even need it? And do you have the other ones that you probably need as a higher priority? I just find it odd that they seem to allocate them incorrectly, in my very, very humble opinion. But also, I have seen, particularly of late, some big changes happen to these types of insurances. So someone messaged me last week and basically said that they had default life insurance with a particular provider, and that provider had sent them a letter that basically said, we are halving the amount of cover that you have. No, would you like to play double to retain the amount that you have? It's basically for your premium, you are having half the amount of cover now. And she had kept that insurance in place strategically because she had a medical event and couldn't get life insurance elsewhere. And she's like, what do you mean you're halving it? I've been leaving it there to be put to work for this very purpose, and you've now turned around and said you're going to halve it. And so that is what you need to understand. Often with these default issued insurances, you don't have a lot of choice when it comes to how much cover you have unless you go and do extra medicals, but they can change the terms on you. Yeah, they can change the terms on you. And I don't really love that idea when your health will dictate whether you can get other insurances, which I'm going to talk about in a moment. So generally, as a blanket rule, I would always assume if you've been given what we call default cover inside superannuation, it's probs got a pre-existing exclusion clause, which basically says, hey, we're going to insure you for this amount. But in the fine print, what you'll notice is that if you suffer something, and my friend, you already had that or symptoms of that before you became a member or before this insurance was in place, no, we aren't covering that. And so people can sometimes think, I've managed to skirt around a health event because they've given me the cover. And I'm like, well, maybe, but you'll probably find that you're actually excluded for it if you ever go to claim. So I think that's a big thing. A, that they can change the cover on you when they like, and that you're likely to have a big fat exclusion clause in there for anything that you've had in the past, which may or may not work for you. It's just important, again, to know. So for me personally, I always would say to people that super issued insurance is okay being the default cover. Like it's a good starting base. It's better than nothing, absolutely better than nothing. However, if we're talking about what is the most likely for you to claim on, it is probably what we consider retail cover. And to get retail cover, you got to jump through so very many hoops. And that is called the underwriting process. So let me just pause and stop here because I'm going to give you a lot of information over the coming episodes, but I just want to make sure we understand each other. You can have adequate levels of insurance through super that might be perfect for you. I haven't seen many examples of those. I haven't seen many examples where I get under the hood and actually look at what they're insuring and think this is beautiful and perfect. Often I'm like, it's got some things that you got to know about. So if you're like, nah, I want to keep what I have, fine. Read what it is and make sure that you are comfortable with what is stated in there. And my top pro tip, because this is contract law, insurance is contract law, you either meet a definition or you do not, is that the way they are written is so boring and so convoluted that if you would like some support and help whilst reading those documents, I'm not offering my services because I would just die of boredom. Read them in an old English accent. You know, like ye old English, aristocratic kind of, oh, hello. It makes it much more funny and much less what the hell is this, because how they are written, I believe, is genuinely designed to bamboozle you. But you need to understand they are trying to keep in line with contract law and make sure that everything is so clearly articulated. But in the quest to do that, they put in so many terms that is like, what does this even mean? I'll come to that in a moment, but just read the damn thing ahead of time, ideally. So if you've read it and you're like, yeah, nah, I think I actually want to get what Jess said, which is retail cover. How does that work? Normally, I would suggest you go and seek help because like a mortgage broker, there are people who exist in the financial advice community who are specialists in this space. You've probably heard us talk about Skye Wealth before. They are insurance specialists. They are one of many that exist in Australia, but they are friends of the podcast. And I'm sure you can find links to go and find out more about what they do in the show notes. But basically, this is their jam. This is what they do all day long. Just like a mortgage broker will know which banks offer certain rules or have a better policy for a particular situation, insurance specialists know that sort of stuff relating to health events, occupations, pastimes, family histories, all across the insurance spectrum. And so rather than you shopping yourself, weirdly, as it were, to all these different insurance companies, hoping that one of them will give you the cover, hoping that you pick the right provider, they will be able to find the best policy for you. Normally, you do have to pay a fee, I think, a small fee, so that they can do all of the preparation and find the right product or policy for you. But similarly to mortgage brokers, often they do get paid by the insurer. So like definitely ask an insurance expert or a financial advisor if you're getting their help, how that all works. And they need to disclose that anyway. And they need to disclose how many insurers they work with so that you can be confident that they've got a good spectrum of different providers to go to. Because let me tell you, the difference between what company A or insurance company A could offer versus insurance company, I don't know, B, C, D, or E, can be enormously different, to the point where you might find company A is like, thanks, but no thank you. We are not giving you cover. And the other insurers might be like, okay, cool, here's a couple of things that we're going to do. Or you might even find ones like, yeah, we'll give that to you, no worries. Why would you do all of that homework yourself and the trauma of going through all the process yourself? I would always recommend that you reach out to them, and they know all of the policy definitions. And in an upcoming episode, I'll tell you a little bit about what I figured out for myself, which had me kicking and screaming at a later date. So let's talk about if you go and see someone, or if you're planning on seeing someone, what the hell you are up for. If you're buying retail insurance, you can hold it inside superannuation, meaning your super fund can pay it. So don't think that it's like one or the other, like, oh, I can't fund it from my cash flow, so it has to just be the default insurance inside super. No, my friends, you can pay for it from your super fund, but the retail cover specifically will require you to go through a lot of assessment criteria. So let's just prepare you, because I have had a lot of people who have done my programs and have realized that they have an insurance need, and then I have warned them, but perhaps not well enough about what the underwriting process looks like. So I want to be really transparent. They are like the people who, I don't know, are sitting at a gate deciding whether they're going to let you in or not, Hotel California, and they are like, you need to meet quite strict criteria to get in here. And once you're in, normally you're in. So they get one shot at the front of that gate to assess the bejesus out of you to decide whether you're in or not. And so they are going to be the most nitpicky, painfully annoying, really overly onerous about letting you through. Because in most retail insurance contracts, once you're in, they cannot kick you out again. It's called guaranteed insurability. Most retail contracts have that. It basically says, hey, if you keep paying your premiums, we'll keep insuring you. And if we change definitions in the future, if they are definitions that are harder to claim on, normally we'll give you your old definition. You get to keep that one, which is easier to claim on. So like there's a lot of benefits that come with retail insurance. Normally broader definitions and more bells and whistles, which we're going to talk about. But you've just got to remember that they are going to ask you absolutely everything, and you have a duty of disclosure. So you got to tell them all the things that are on your medical records. And I'm talking, they want to know your family history, what you do for work, what your pastimes are, if you smoke, if you drink, if you've taken drugs. They hate drug use, by the way. Anything that's on your medical record, any meds that you take, anything that you're worried about, any ops that you've had, all the things. And so they can write to your doctor, they can have people come to you and, I don't know, take blood from you to do a check. Like it can be quite invasive. You can have a conversation. Normally, a lot of the time, you will have a conversation with the insurer that's called a tele interview, and they're going to ask you a bazillion questions because basically they're trying to work out, do we want to take you on as a client? And the answer to that could be, yes, we want to take you on as a client and we want to give you everything that you've applied for. That is extraordinarily rare to get it as is, no amendments, no changes. We actually in the insurance world call this a clean skin. Now, we can debate whether that is the right word to use or not, but that is the word that is used. You just mosey on through those gates and hopefully live happily ever after, both for you and the insurance company, because then they don't have to pay out a claim. They are so rare. So rare that we actually are like, oh my gosh, is this a clean skin application? Like it's commented on. Let's talk about what's more realistic. Often you will have exclusions. They are exactly as they sound. They are not comfortable covering a particular ailment, area of your body, situation, and it could be you've had a back injury. They're not comfortable covering your back. So you'll have a back exclusion. Or you might have had a period of mental health, or you're on medication for mental health purposes and they exclude mental health. You might have had an ankle injury a couple of times from playing sport. They might exclude your ankle. You might have a family history of breast cancer and you haven't had a test, so they are not sure whether you are at risk or not, so they might exclude that. These are all very common. The most common ones I ever saw were back exclusions and mental health exclusions. And there can be this frustration because you've like adulted to decide you want insurance. You've adulted enough to get someone to help you with it. You've done all of the bloody questions, which felt like you were being interrogated, only for them to come back and be like, yeah, we're not covering you for the thing that you are probably the most worried about. That is often where people pull the ripcord and they're like, I can't be bothered. If they're not even going to cover me for the thing that I'm actually worried about, I can't be bothered. Let's just pause and think about whether that is the right strategy. If you are covered for absolutely everything else, and that means that you are protected for X, Y, or Z scenario, is that still a better outcome than what you're currently dealing with today? And if the answer to that is yes, then you probably want to move forward even when you're pissed at them for excluding the thing. Because remember, once they let you in, they can't change their mind. So they are going to be the toughest at the beginning. And what you need to know is majority of the time, once you're in, you can actually ask to have your insurance reviewed. So they might say, look, your back's still playing up, you're still getting physio, you're still getting chiro, we're not quite sure what's going on here, we're going to exclude your back. But they might say, if you have a period in the future where you don't have a back injury for a couple of years or you don't have treatment for a couple of years, we can review it. Or they might say, hey, once your blood pressure's down to this level for a certain period, we can review your exclusion. That's on you, my friend. The insurer's not calling you up on a Wednesday afternoon going, hi, my name's Jessica. I am here from Insurance Company A. We would like to offer you a review of your exclusion. They're not going to do that. You have to go, hey, advisor, or hey, insurance company, it's been 2 years, or my blood test says this now. Can we have that reviewed? So they will often tell you if it's a non-renewable event, like, yeah, nah, this is not going to be something we can look at in the future. You can still apply for a review. There's no harm. The worst they're going to say is no, which is where you're at the moment. But when you know that time has come, call them, call whoever, and see if it can be reviewed. Just put it in your diary as soon as you get told how long it is until it's reviewable, and try. Just try. The other thing they can do is they can load you. And load means pay more premium. So they can be like, okay, cool, we want to cover you, but the quote that you've been given doesn't take into consideration X, Y, or Z to do with your health event. And because we believe that puts you at a higher risk, we are going to charge you more for it. Now, this can sometimes be based on a health event that they don't know it's hard to exclude. I'll give you a classic example, and hopefully I'm still in the know enough to remember this correctly. Like diabetes would be an interesting example, because diabetes can affect many parts of your body in different ways. If they were trying to exclude every particular area that might come up as an issue with diabetes, they'd probably exclude half your body, because it can affect your organs, your hands, your feet, your eyes. They're not going to be like, here's a contract with like a bazillion things excluded. They may just say, we're going to cover you potentially, but we're going to charge you more money. And so they'll put a percentage-based loading on. Again, sometimes this is reviewable. So put it in your diary to have it reviewed, because the last thing you want is to be paying more than you need to for longer than you need to, if by that point in time you've been able to potentially resolve something and they feel like you're back within adequate risk limits, because they're always just assessing, what is the risk here? Are we going to lose money here? And remember, for every 100 people that have your issue, whatever's going on, even if you're like, but I'm fine, if 100 people had your issue and also felt fine, is one of them going to claim? Is two of them going to claim? And when we're talking about really large amounts of money, this is where it becomes an issue, and this is why they're so particular. The last outcome, which is a bit shite, is that they say, thank you so much, but we actually don't want to give you cover. They don't do it as petulantly as that. They say, thank you so much, you've been declined. Now, if you work with an insurance expert that is good, which I'm sure you will, they should be able to pre-assess you. So basically they sort of offer up your information and say, hey, confidentially, if you had a person that was a bit like this, what would you do? And based on that, if they know you're a decline, they won't apply for cover, because once you get declined, it's on your medical record. You got to disclose it moving forward. So pre-assessments is a big part of this underwriting process to get you good quality cover, because they want to shop it around to other insurers to be like, would you also have the same outcome, or would you be prepared to give it a go with maybe an exclusion or a loading? If unfortunately though, you go through the whole process and then, I don't know, maybe you didn't disclose something or something comes out of the woodwork and then they decline you, it's a bit annoying, because then if you haven't been able to retract that application first, then I'm sorry to say you are going to have a decline on your record that you need to disclose. So ideally, you want to work with someone who's going to pre-assess you properly. If they think it's going to be declined, they'll want to pull the application ahead of time. But if you do get declined, which happens, it happens. And I used to see it a lot with my clients because they didn't tell me about drug use. And the insurers have some strange aversion to people being honest about drug use. And it would come up in their medical records. And I'd be like, oh, how annoying that when they were like 19, they once dabbled in something. And I don't want to pretend we live in a world where that isn't, I don't want to say a usual occurrence, but it happens. And I used to fight with them tooth and nail and be like, hey, they're honest. Why are you being mean to them? But anyway, they used to, I don't know their current views, but they used to have quite an aversion to, say, drug use, and they would decline it. And if you hadn't told the advisor that, or if, when I was an advisor, if my client hadn't told me that and it come out in some sort of Medicare record or doctor's visit record, and then the insurer saw it and declined it, it would then be on their record. So it is so much better to work with your advisor or insurance expert to tell them all the tea so that they know what they're dealing with, so that they can try to find you a company that is going to be as commercially minded as they can be to take you on. So that process can take a little while. It can take a long while, and you might need to get specialist reports and all the things if you've had medical events. And if you do get declined, it feels like you've not been accepted onto the sports team. When people are picking the sides and you're just standing there waiting and watching as everyone else is getting picked except you, it feels a little bit like that. But I want you to know, if you do get declined, there's a couple of things. A, you might already have that default cover that we talked about inside super. It might not be perfect, but it might be something. Secondly, you might want to consider whether you need to beef up your emergency savings. Because if you know, okay, cool, I got 3 or 6 months, like that's awesome. But then you're like, oh, well, I've just been declined for cover. Shite, I might need a bit more than that. Then that can be really important to learn ahead of time. So you might need to keep more assets in defensive or conservative style portfolios or keep it in your offset account or whatever so that you've got a longer period of time or a longer runway to get better if anything's happened to you. Because normally if you've been declined, you've also had some normally health event. So you know, okay, things might not go as well as I'd hoped. I can be a bit more open to the idea that I need to hold more money in cash, which can feel frustrating because it feels like it's just sitting idly. And you obviously want to make sure you're getting a good interest rate if it's sitting in a high interest saver account or it's offsetting a non-deductible debt if you've got one. So it can be working somewhat for you, but it's obviously not necessarily going to be potentially offering you the same returns as if you put it, I don't know, in a portfolio that's in growth-based assets, but it is something worth considering. And then the last thing that I want you to know if you get declined is ask them about accident-only cover. You might find that there is an option for you to get accident-only cover. Of course, it is covering only accidents, my friend, but at least you're covered for something. And for a lot of people, particularly younger people that I worked with, that was actually the main issue that they were worried about anyway. Whereas I was like, well, I'd ideally, aspirationally like you to be covered for like, I don't know, everything. But if we can only get you accident cover, at least we know if you have a car accident, you get hit by a bus, if something really shite happens and we've had some, when I was giving advice, we had some weird and wonderful accidents occur for our members. And at least they would, if they had that cover, probably be covered for those events. Okay, after the break, I'm really quickly, because I'm like attempting to keep my episodes short, which you can see doing a very good job of. I'm going to talk about life insurance, which is the simplest and easiest one to wrap your head around. And what you need to know about, think about, understand when it comes to getting the right level of life insurance for you, asterisks, and for your family.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to moneypodcast.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia so they can connect with you wherever you are. That's moneypodcast.com.au and click Get Help.
Okay, now let's get into life insurance, specifically like the product-y style stuff that I think need to know about. But I felt like I really needed to set the scene and probably did a very long, laborious job of that. But people just do not get it until it's too late. And like, I'm in a privileged position to help you not be in that situation. So like, why not labor on that? Let's talk about life insurance. As I said, I often find that it's misaligned in terms of when people get it as a default because it's not necessarily always a reflection of what they need when they need it, but it is likely, dear listener, that you have some form of life insurance. So we're going to decide, hopefully, with my help today, whether you need it, whether you want it, what you need to consider. And when I was wrapping up before I went to the break, I put a little asterisk and said, for your family. I think that is the really important point when we talk about life insurance because, yes, we can say it's life insurance for you because technically it is on your life. It is actually not really for you at all. If you think about what life insurance is, it is insurance in case you are no longer around. Why does that matter? Well, it's actually to support your financial obligations and your family if you were to die. Probably should have issued a trigger warning, and thus I will issue it now. For the remainder of the series, there's going to be things that we talk about that are heavy but important, so please stick with me. And we all know people that have been impacted by life events, and I'm sorry to say that we all will die at some point. I know, I'm still obviously coming to terms with it. So we have to just be pragmatic and recognize that now may not be the perfect time for you to listen to it, and if that's the case, you just mosey on away and come back in a couple of weeks. But if you know that actually it is time to get serious, and even though it feels uncomfortable, even though you may have had a situation where someone around you has passed away, you need to like listen, then I'm here and I'm with you. And I will say, because I did say from the top of this episode, like my family has just been in a state. We're just been in a state. Many of you who've listened to the podcast for a while will probably know that my biological father, which is confusing because I also talked about my dad who's having some syringes putting into his neck today, is actually my stepfather, but I call him dad because bless him, he's been having to put up with me since I was about 3. But my biological father actually passed away when I was 4 months old. He had a brain tumor, which is awful and has one of the lowest survival rates of all of the cancers. And my mum was told that he was not going to even see me be born. And like, she was 24 when she got pregnant with me. I am a lot older than that and sincerely cannot even genuinely wrap my head around the idea that you would be having a baby and a partner leave the world at exactly the same time. So he passed away when I was 4 months old. I think he was like just 28. And of course, him, like many, thought young, fit, healthy, whole world ahead of me, tradey. He got income protection because my grandfather sort of bullied him into it. But what the hell did he need life insurance for? Well, turns out he actually needed it for when he passed away and his wife and his tiny baby, which was me, were going to have to like deal with the real world without any money. Because 25 isn't a huge amount of time to have built a considerable amount of assets, especially when you stop working to have a child and probably grieve. And so if you are telling yourself or your partner is telling you, babe, I don't need it. Look at me. I'm brilliant. You need to remind them that actually life insurance is to protect the other people that survive. It is to have them not plunged into financial ruin. Because in some ways, like, thank God my parents didn't buy a property before he died, because I don't know how we would have funded it. My mum probably would have had to fire sell it. And look, maybe she could have made some money. Or she might have defaulted and had the house ripped from her. The bank might have been like, yeah, we lent you the money based on 2 incomes and it appears that you have not even 1 income at the moment because you've had a baby. We are calling in this loan. You never, ever want that to happen. So the reminder is that life insurance is if you're not around, which is going to happen at some point, but it is also for the people who are left. And what would they be left with? Would they be left with a giant mortgage that the bank would say, no sunshine, you can't service that? Would they be left with little people, a la me at 4 months old, who are cute but expensive? And how many years are you likely to have financial dependence reliant on the person who has survived? And what kind of cost would that practically need to, what cost would you need to factor in for them, particularly if you had hopes and dreams that they would go to a private school or be able to have enough money to, go and do any sort of travel or whatever. You can see I didn't have any of these things, right? My poor mum had to figure it out. But if you know we have a debt, we have dependence, or we have needs for, extra support that my partner, if they were left to fend for themselves, could not support financially, I need to cover that. Maybe you have kids where you would need actually practically someone to drive them to and from school every day, to do after school care, which you currently don't pay for. Maybe your idea of your parents just chipping in isn't actually realistic for the next decade if that was to happen. Maybe you need someone to clean the house, do groceries, cook. If you actually look at some of the costs of those year on year, it is astronomical, which we can have a whole different conversation about unpaid care and work not being valued in a home. But if you were actually needing to pay for it, you would probably be very surprised at the cost every year to the budget. And I think that needs to be considered. So if you're young, footloose, fancy-free, no debt, no dependence, no interest in either of those things either, you might think to yourself, what the hell do I need life insurance for? And the answer is, I don't know. You probably have a very valid question there. Do you need life insurance? Maybe not. But remember I talked about that whole underwriting process, which I went on and on about? When you are young, fit and healthy and haven't had as many health events, God forbid any health events, you could argue that potentially is the best time to get all your insurances sorted because it's not going to be as hard to jump through those hoops. The problem is if you wait, a decade or so, because now you're like, okay, now I got kids, now I got a giant mortgage, now I need to help my partner if something was to go wrong. That might be the time where you are actually riddled. Riddled doesn't sound nice. You have had a few health events and then that's when they're like, yeah, nah, we're not giving it to you. So young, fit and healthy, no debts, no dependence. You either fit in one of 2 camps. You're like, I don't need it. I don't want to get it. I'm going to save my cash. Cool. Or you go, actually, I'm future-proofing because I think that this might be something that I need and I'm happy to pay for it now despite the need not being huge because I want the assurance that in the future, if I need it, it's already there waiting for me, and I've not had any medical events that haven't been covered. You can sit on either of those camps. Now, I am someone who has life insurance. I have so much life insurance. Like, honestly, touch wood, I survive out of the studio today. But if you look at my situation on paper, I have debt because I have a mortgage, but I have life insurance that more than adequately covers that debt, and I have assets and superannuation that would be dispersed. You could look at me and think, why do you have life insurance? And it's a valid, very valid question. But now that I'm uninsurable, I am paying that bill first. Thank you so much. But frankly, if I was not here anymore, I don't have little people that are financially dependent on me. My assets could be sold and the residual of that could get split as per my will. I have just made a determination that I personally want to pay for that insurance to future-proof myself and my future events. God knows where they will take me. And I'm really happy with that outcome because I am now uninsurable. Let that be a lesson for you. And I just also need you to know that whoever you have nominated on your life insurance policy is going to get your life insurance if you die. I'm just going to say that again. Whoever is nominated as your beneficiary on your life insurance policy is going to get your life insurance if you die. Now you might be like, yes, Einstein, that's what it's there for. And then I say, sure. But isn't your ex-partner still your beneficiary? Have you forgotten to update your beneficiary and now you have a new partner and God forbid now you have new kids or more kids or some kids? People are like, shite. But I updated my will? Isn't it updated in my will? Won't it go through my will? And the answer is it might go through your will if you have made your legal representative the beneficiary. However, wills can be contested, depends where you live, all the rules are kind of complicated. But insurance as a general rule of thumb is a non-estate asset. It does not form part of your will. So if your ex-partner is your beneficiary, they are probably not dancing on your grave because let's not hope that that's how happy they are that you're not here. But they probably are quite happy that you have forgotten to do life admin and kept them as a beneficiary. Because no ifs, no buts, and this has been tested several times through the courts. If you nominate them and you don't change it, it doesn't matter what your life has happened. I'm not a lawyer, asterisk, go and get legal advice. But they will get the life insurance. So make sure it's updated if you've got life insurance. Make sure it's your legal representative if you want it to be as per your will. Obviously, make sure you've got a will and make sure it's up to date. And know that there is more contestability. It might be perfect that it's already set at whatever percentages, because you might have a messy, complex situation and you want some certainty that certain people are going to get the money. But I have just seen too many situations where people have just forgotten. And thankfully, in my experience, clients I've worked with not died, not had to tell their ex-partners that they've effectively won the lotto. Can you imagine getting a call out of the blue going, hi, you know that person you dated 5 years ago? We're so sorry to tell you that they have passed away. Oh, shit, that's awful. I'm so sorry to hear that. Yeah, but they had $1 million of life insurance and you're the listed beneficiary. Can you send us some deets and we'll send you the money? What? What? You might find that they're a nice person and say, oh, well, I know that they've remarried and they've just had children. Maybe I'll pass that money along. But do you think that happens when the time comes? No, very seldom does that happen. So for God's sake, if you're going to have life insurance, figure out who needs to be the beneficiary. Make sure that they're valid and up to date and update it if you need to. If your friends are going through a separation, send them this episode. You are welcome. And go and get estate planning advice if you need it. You also need to know that inside superannuation policies have a bit more complexity in terms of how the money is taxed on the way out, depending on who it's going to. So there are particular rules about who can have the money tax-free and who has to pay tax on it. And so definitely go and speak to an advisor about that, because normally if it's paid to a tax dependent, which is generally defined as a spouse, a child under the age of 18, or someone who is financially dependent on you, which is a bit grey, that payout is normally tax-free if it's through superannuation. However, if they are considered a non-tax dependent for life insurance through superannuation, which could be your kids that are adult and not reliant on you anymore. Although in these times, are adult children ever not reliant on their parents? I think it's a valid question. It might be your siblings. It might be your bestie. It might be, I don't know, a charity. They are considered non-tax dependents, and you might find, or they might find, that they are taxed up to, I think it's like 30-something%, including the Medicare levy, which again could be fine because you're like, well, they're going to get the residual, like 70% of that's a lot of cash. But if you know that you've made it a specific amount so that they can, I don't know, clear their own mortgage or take on your children or whatever, to have 30% of that, like let's use $1 million example, $300,000 of that going into tax is a lot of money if you haven't prepared for that. Worth thinking through. So life insurance is a really fancy, cleverly worded insurance for death insurance. You are no longer here, or you are not likely to be here for very long. Sometimes you can get paid out for something called a terminal illness, where you're normally not likely to be here for 12 or 24 months, depending on the definitions. Because remember, devil is in the detail, contract law. I like this option because it means people get cashed out ahead of time. They can make their own decisions on where that money goes and how it is all handled. They can like prepay for their funerals. They can live their bestest lives and like blow it all if they want to, because like it's on your life. The natural question that I used to get a lot when I was explaining terminal illness, and like it's such a morbid thing to talk about, and I really recognize that, but you know, they would say to me, what happens if you get paid out and you live? I'm like, well, you can't die twice as far as I'm concerned. However, normally, if you somehow radically and miraculously survive, my understanding is that the insurer doesn't then knock on your door 12 months or 24 months and one day later going, hi, we paid you because the doctors told us you weren't going to be here, and like, here you are, could we have our money back? That is not, in my experience, how it works. They will give you the money, but what they will say is, well, congrats, you survived. Genuinely well done you, but now you do not have life insurance. So like, do whatever you want, but you're not going to be covered for that amount again. Just something to think through. So, in wrapping up what has been an accidentally juicy first episode, it's going to happen to all of us. At some point, we're all having a health event. I'm just putting it out there. Said with love. Go and look right now or today. Just take 5 minutes out of your day. You have 5 minutes to check this stuff. What have you got through super? Just as a starting point, or what life insurance do you have? And does it match your current situation? Is your debt higher now than what it was before? Do you have more children now, or no children that are no children that are financially dependent on you anymore? Well done you. Have you found that you've separated and you no longer want that person to be your beneficiary? Like, now is the time to do a little bit of hygiene. Maybe you're like, actually, I have $355,000 worth of life insurance that I pay X amount per month through my super through. I don't have debts. I don't have dependents. I don't think that that's going to be me in my future. I actually don't want that cover anymore. Then you might want to decide whether you want to keep that or not. My very general rule of thumb across all the insurances is before, for God's sakes, before you decide to cancel any of your insurances, go and get a health check. Because you just never ever want, and Murphy's Law will tell you that the moment that you decide to cancel it is that when something shite is going to erupt on your lap. And you're like, of course, because I got confirmation that it cancelled yesterday and today I get told X, Y, or Z. So let's just nip that in the bud. If you don't need it, fine. You are well within your right to cancel it. It's yours. But why don't you just do a health check first? Go and get some bloods. Just make sure everything is hunky-dory. Might take you a little bit of time, cost you a little tiny bit of money. But if it means that you are not then cursing yourself and all the insurers because something happens the day, the week, the month after you cancel it, you will be grateful for that investment in your peace of mind. No one wants bad things to happen to them, but even more so, no one wants to leave their family in emotional and financial distress and ruin. Please remember that if your partner doesn't want to get insurance for their life, that is going to absolutely and inextricably impact you if they're not around. So you need to advocate for yourself and say, fine, then I won't cover my life because if I'm not around, you are saying you don't want life insurance. You can just handle the bullshit situation. Sure. I am not signing up for that. I would like you to be covered so that if you left this world, I wouldn't be financially screwed. Please and thank you. And remember that you're going to need to get help if you're going through that retail cover process to get through all of the underwriting process. I mean, you can do it yourself. I just think you would rather pull out your own teeth because it's a lot of work and you don't definitely don't have the time nor inclination nor expertise to be able to understand all the different definitions. Life insurance is actually the easiest one. If you're going to go and do it yourself just for life insurance, sure. But throughout this mini-series, I'm going to give you the other insurance types and it'll become far more obvious why you would want someone in your corner advocating for you to get it done. Another short and sharp positive episode from me to you. Today, I'm going to come back and we're going to talk about the other types of insurances. If this is helpful, if you know you have a friend that has just gone through a life event that probs defs needs to have their insurances reviewed and they maybe are good at putting things on their list, not as good like me at taking them off the list, I would just send this to them and be like, you are so welcome. Or would you like to have a do-it dinner with me and we just sit and review this stuff together, band together to make it less painful would be my hot tip as well. Good luck with your first piece of homework. I can't wait to see you in the next episodes. You know what to do. Go now and be financially fierce. Bye. Bye.
We acknowledge the traditional owners of country throughout Australia. We pay our respects to elders past and present. Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Jessica Brady is an Authorised Representative of Paragem Pty Ltd, Authorised Representative Number 1259972, AFSL 297276, ABN 16108571875, Corporate Authorised Representative Number 1305567.